Hi, and welcome to Midas Investing. Today, we're going to be taking a look at Charles Schwab Corporation, ticker SCHW. Charles Schwab is one of the largest and most prominent brokerages in the United States on a scale similar to Vanguard in terms of assets under management, or even Fidelity when it comes to total user accounts. I have been paying attention to this company a little bit behind the scenes for quite some time, peeking through its value a little bit, and just finally got around to making a full model for it. Let's take a look. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. Hopping over to take a look at some of the basic information of the company. Here we have the active brokerage accounts here in total over the course of the last decade. And you can see this large jump up here between 2019 and 2020, which is when they made the acquisition of TD Ameritrade. And they've been slowly been integrating these accounts fully into their system while getting rid of a lot of redundancies within the system as well. And backdrop against that, the red line actually shows the percentage that these millions of active users that they have as a percentage of the United States population. So it gives you a sense of their overall prominence in the space. Obviously, not every person in the United States has a investment account in the first place, but the point is it still gives us a scale against the rest of their competitors, so to speak. You can see that they had gone from a little bit less than 3% up to a little bit less than 4% up through 2019. Not exactly a huge increase there, but still showing a pretty steady increase in overall prominence. Keep in mind that the US population itself was growing over that entire time frame. But then with the acquisition and the integration, they've now popped up over 10% in the most recent year. Now, the way that I built this model is attempting to find ratios or percentages or some other measure that I can use to essentially scale one part of their business down to another part of their business on some sort of consistent basis. I worked through a variety of different ratios, trying to essentially narrow in on ones that have the smallest amount of deviation over time periods that I think are the most relevant for each one, so that I could try to effectively build into the different types of revenue that they have for the company. I just say that right here at the start because there's going to be a lot of measures that I need to go through and explain. Like I said, it's kind of a little bit of a complicated model. But here in this next chart, I'm showing the average client assets. And what that is their total assets divided by the total amount of accounts, which we just saw on the last chart there. So here you can see in 2013, they had approximately $247,000 for each active client that they have. Then that peaked in 2019 at a level of 327,000. And then with the integration of TD Ameritrade, it dropped pretty significantly down to in the 200,000s, which grew a little bit in 2021 and then shrank a little bit in 2022. Though, of course, it's always keeping in mind worth noting that in 2022, we had pretty significant equity declines in general. So the reason why I'm doing this is because it's much easier to make a projection for where the U.S. population itself is going to go. In fact, the U.S. government makes projections for that, and we're going to rely somewhat on estimates for that, as well as we're going to be trying to take into account how much of the overall client space that they're going to be able to hold, as well as the amount of assets each person can have, and we're going to use different measures for that. Speaking of measures, the red line in the backdrop is this average amount of client assets for Schwab themselves as a ratio to the median income in the United States. And this gives a good example of what I mean of trying to find measures that had relatively small amounts of deviation. You can see that between 2013 and 2019, it was a pretty steady measure, ebbing and flowing a little bit between kind of like, what is it? The lowest one we have here in 2018 is 8.3. And then the highest one we have is, I think the year after that, 2019, although we had 9.1 at another point as well. It did drop pretty significantly when they started to integrate TD Ameritrade, and as well as we did have the large equity declines in 2022, which is going to affect that as well. But the point is, I think that it shows that this gives us some sort of baseline of thinking about where this measure could go over time. It's worth noting that the integration of TD Ameritrade, it's a different business with a slightly different clientele with different sets of assets. So it's probably not going to necessarily go up to this same level again in the future. There might be some sort of middle ground in between that, but this gives you some sort of bearing of where I'm going to go with the model as I build into this. Now, this next chart here is trying to show you how I'm going to put together at least the lion's share chunk of the revenues that they have, which being a brokerage and a wealth manager, obviously interest income is going to be a huge portion of their business. And netted against that is going to be the interest expense that they pay out, giving them the net interest revenue, which makes up a pretty significant portion of their overall revenues. So we have the interest income over the last decade here in the backdrop. You can see it was rising with the rising of interest rates that we saw up through 2019. And then obviously interest rates dropped back down again in 2020 and stayed that way in 2021, though interest income did start to rebound a little bit. And then in 2022, we have had interest rates starting to go up, and they can have a pretty significant increase right there. Now, the red line backdrop against all of this is the interest income as a percentage of the total assets that they have. It gives you an idea of essentially their cut of the interest itself. Some of the lowest points we have here in 2021, we have 1.6%. In 2019, it was at its highest point of 2.8%, most recently at 2.1%, but showing a pretty steady line right here. Now, it is obviously worth noting that, of course, interest rates throughout the economy are going to have a pretty significant impact on these ratios as a whole, but that's a little bit of a harder thing to make any sort of prediction on itself, being that that's just a macro prediction in of itself. And I kind of wanted to steer clear of that for this valuation. Now, backdrop against both of those, we also have the interest expense. And it's worth noting that the interest expense is significantly less than the interest income. They do have a significant amount of bank accounts as well as cash balances throughout all of the other types of accounts that they have. But even as interest rates rising up through 2018 and 2019, as well as in 2022, you can see that it was not rising nearly as fast as interest income, at least in total nominal terms. You can see in 2022, it did significantly increase, almost tripling between that for the interest expense. But obviously, interest income had much larger of a head start. So it still shows that the gap itself has increased in total nominal terms. Then the other line, the green line here, shows that same interest expense as a percentage of the interest income. So I scaled the interest income against the total assets of the company or the client assets of the company, and then we scaled the interest expense against the interest income. I did play around with a few different ways of measuring this. Like I said, I was generally trying to look for something that I found to have the lowest amount or the most consistent amount of deviation in a way that I found predictable for making projections in the future. And so I found that honestly, just scaling the interest expense against the income to be the most useful measure. Even though, yes, you can see it did move up and down pretty significantly from around this kind of 5% point, and even lower than that at some points here, going up over 12% and even up over 14% through 2018, 2019. And then most recently, it was at 12.5% or so. So the point is, I think we can also generally find some sort of middle ground between here, some sort of deviation between it for our bear, base, and bull cases for our model. On this last chart here, this shows the overall revenue of the company broken down by different category. As I had just shown you guys, the interest income minus expenses, which is the net interest shown here in orange, is the lion's share of the business, which is to be expected from a company that manages so much assets as they do. But then behind that, we have in the green the asset management and admin fees, which essentially makes up a section of the business for fees related to their mutual funds, as well as the ETFs, and some fee-based trading solutions as well within this category. And below that, we have trading revenue, so actual fees on stocks being bought and sold, as well as options and other things along that category as well. And then we have bank deposit fees, which really only start to show up in 2020, but you can see that they've grown over time as well. And then below that, we have another category, which includes a whole variety of other things, including some communication fees, and moving money movement fees, and a variety of other things. All right, now hopping right back into the model, we can start to break down all of these different line items that I have right here and start to make sense of how I put together the revenues and expenses for this company. Up at the top, we have the US population over the years for the last decade and the projection from US government services of about 348 million in 2032. We're going to use that as our baseline, like I said, for trying to make estimates of where the total active brokerages or accounts are going to be. Over time, we had the percentage of the population that it has, most recently being around in the 10% range, as we were saying before. And in general, we're not really going to assume that there's too much growth or too much shrinkage in terms of that going forward. In our bull case, we're going to be assuming that it is, in fact, going to be growing by a little bit up to maybe 10.4% in the bull case scenario. And then our bear case, we're actually going to assume that perhaps this percentage of the population drops down to maybe 9.4%. And then the base case about halfway in between that. Now, this is, like I said, perhaps a conservative estimate. They might be able to make more gains over time, but they could also lose more ground over time. Keeping in mind, like I said, the U.S. population itself is going to be growing, and so that's essentially what we're going to be seeing the growth of the total accounts coming from over time. Either way, getting us anywhere between 32 and 36 million total active accounts in 2032. Then next, like I said, for the actual assets, we found the median income itself to be pretty useful of a measure in terms of trying to think about where the actual assets themselves are going to grow over time. Most recently in 2022, it was up to $37,500 USD as a median income in the United States. And we're just going to make a projection of relatively simple percentage growth rates over the course of the decade to get us anywhere from $43,000 in our bear case up to 58,000 in our bull case, or anywhere from 1.4% compounded per year to 4.5% compounded per year. Keeping in mind, for example, over the last decade, it did grow at 3.4%. And in general, it tends to be somewhere within a percentage or less of the CPI. You generally want the median income to be growing a little bit faster than the CPI, but it usually doesn't grow too much faster than that. So this kind of gives you an idea of like kind of how I got to these sort of numbers, both based off of historics as well as the idea of like perhaps what inflation might be moving forward. So then also in the charts, I showed you the ratio between the median income and the client assets that we had, the average assets per client in general going forward, which we had seen that had been up to possibly around 9.1 as a ratio at some of its highest points. But ever since the TD Ameritrade acquisition, it has dropped down more into the between 5 and 6 sort of range. And so in terms of thinking about where that ratio is going to go, it definitely, like I said, it's hard to say maybe how much ground they'll be able to gain back. They undoubtedly will gain some ground back after integrating everything over time. But the idea that maybe they'll get up to those peak levels is perhaps a little bit too bullish for my taste. But either way, I have it essentially set to 6.1 as a ratio for the bear case, and perhaps 8.8 in terms of the bull case, with 7.5 being the base case in between that. If we then scale that up based off of the median incomes that we projected, that gets us up to 264,000 in the bear case, and possibly up to a little bit over half a million in the bull case. And if you then extrapolate forward with the account measures that we already had, that gets us to client assets in total of 8.6 trillion in the bear case to possibly 18.6 trillion in the bull case. So you can already see, after just making a few different extrapolations within this model, it's already starting to show some pretty wide variability in terms of the asset base itself, which I'm definitely going to point that out because, as you'll see when we get through the whole model, the total potentials for where the revenues can go for Schwab is definitely pretty high, depending on how you look at things in like the bullish end of things. I did try to counteract that by being reasonably conservative in a lot of the bear case assumptions, which you'll see in general where that ends up leading us for the total revenues for the company as well. But either way, like I said, I kind of wanted to mention that going forward. So then we have to then break down from just the client assets into trying to make projections for the different categories of revenues for the company. For interest bearing assets, I chose to take them as a percentage of the total client assets and look at how consistent those ratios were over time, which I did find them to be pretty reasonably consistent, though growing a little bit over time and depending on the time frame you look, going anywhere from about 5% up to 8% at different points in time, on average being about 6.6% and ending at 8.4% most recently. So going forward with that, we have projections for the bear case up to 5.8% as a percentage of total client assets and 7.3% in the bull case, which then gets us up to about half a trillion for the interest bearing assets in the bear case, and 1.3, 1.4 trillion in the bull case. We used a similar measure for the advisory assets that they list for us, finding that the average advisory assets was pretty consistent around the 50% mark, about 51% on average. And so in our bear case, we have it at 49.1%. In our bull case, we have it going up to 53%, which sits within the general bounds of the highs and the lows we saw over the total decade. And then if you extrapolate that from the assets, that gets us up to 4.2 trillion in advisory assets in the bear case, 9.8, 9.9 trillion in the bull case estimate itself. Now, for the bank deposits, we didn't actually use the total client base as a measure for trying to make projections for it, because I actually found that we an even more consistent way of taking that measure, which was the bank assets as a percentage of the interest bearing assets, because bank assets are interest bearing assets. So in general, we found it to ebb and flow a little bit between the high 60s and around the 80% range, about 73% on average. So our projection in the bear case is 68.7% and up to 77.8% for the bull case, which leads us up to a little bit less than 350 billion in the bear case and a little bit over 1 trillion in the bull case for total bank deposits in 2032. Coming down, as I had already talked about, we have the interest income as a percentage of the interest bearing assets, which in general has stayed around the 2% line over the course of the last decade. Our bear case, we have it at 1.5%, and our bull case, we have it 2.4%, and it's sticking in between the middle there. That builds us up to about 7.7 billion in our bear case estimate and 33 billion in our bull case estimate. So you can see even just with that one measure, we end up getting a pretty significant different scale in terms of the revenue that the company could possibly be getting. And of course, this partially has to do with the fact that we have a pretty large difference in scale of the types of assets that the company might be managing going forward a decade. Keeping in mind, for example, that they had 7 trillion in assets in 2022. So the idea that in one decade's time they would be up to 8.6 trillion in assets is a pretty small amount of growth compared to the levels of growth that they had previously. So perhaps getting up to 18.6 trillion is perhaps not necessarily unreasonable. It is a pretty significant amount of growth for the total asset base, but perhaps that does come off of the back of maybe another integration from another company. Who's to say? But coming down, we also have the interest expense, as I had shown, relative to the interest income, which we had found it to be on average about 7.8% over the course of the last decade, though this one did have a little bit more variability within it. But nonetheless, it was still kind of the best measure that we could find with the least variability compared to trying to scale it against some of these other measures. But that if we did, we have to kind of think in opposite terms where we want in our bear case to have a higher percentage because it's an expense, in our bull case to be a lower measure. So we have 11.6% in our bear case estimate and 4% in our bull case estimate, which gets us 900 million in interest expense in the bear case, and 1.3 billion in our bull case, which of course you might say, well, it looks like it's getting bigger on the end of it. And that partially again has to do with just the overall scaling of the different possibilities for the company here. Then we have asset management and admin fees, which, like I said, is scaled against a lot of the ETFs and the mutual funds as part of their business. But the way in which I chose to scale it for this was not against their total client base, but against the advisory assets. I found that to be again the most consistent way to go about this. It was about 20 basis points on average throughout the whole course of the decade, though it did vary quite a bit. In fact, it varied also pretty significantly ever since the TD Ameritrade acquisition here. And I will say, keeping in mind with that, since obviously they did have a pretty big transformation of their company and their business in 2020, some of these averages and the deviations I chose to use only go up through 2019 because I chose to kind of ignore the changeover in their business depending on some parts of their business. There were some exceptions where I was using the full 10 years and other ones where I was actually using the more recent few years. It kind of just depends on which of these measures. But again, I was looking for something that gave me a little bit of a consistent measure with a small amount of deviation relative to all the other options that I could think about. But moving forward, the projection that I chose to use for that cost basis for the admin fees, I chose to go with about 10 basis points in the bear case estimate and 18 basis points in the bull case estimate. So in general, we're seeing that they probably won't be able to gain too much ground back relative since the acquisition in the bear case, but perhaps it'll start to scale back up as things start to be reintegrated a little bit in the bull case, perhaps getting up to some of the higher levels, though not up to the peak levels that they had previously. All right, now for the next category of their revenues, we have the trading revenue, which for this one, we end up doing something a little bit differently. We're not taking it as a percentage of one of the asset bases. We're actually taking a look at the total amount of trading fees per active account. As we had talked about, there is the total account measures that we've built up over time. And I found this to be the most consistent way to build this particular measure up. Going back and taking a look at the consistent history of it, and back in 2013, it was around $100 per account, and it had come down to about $50 per account in 2019. And then in 2020, we didn't see too much changeover. I don't think there was much integration of those types of the accounts into their business yet from TD Ameritrade. But then in 2021, it jumped up to $125 and then down to about $108, $109 in 2022. So you can see there was very significant swings depending on what was going on in the business for this. So it's definitely a little bit of a trickier one to try to make projections for, but we're essentially going to try to assume that it's probably going to be a little bit more on the conservative side, or at least I think, but somewhere in the middle in terms of that overall changeover over the course of the decade. I have it up to $58.50 for the bear case estimate and up to about 96, almost $97 in the bull case estimate, which builds up to about 1.9 billion in trading revenue in the bear case and 3.5 billion in the bull case. Then when it came to the bank deposit fees, we really only had a few years to work with right there. So we basically just ran with what we had, the average being about 27 basis points of a fee relative to the overall bank deposits that they have for the company. And so with that, we end up trying to scale as best as we can against that relative to the best and the worst, even if it is a small sample size of only three. In our bear case, we're assuming about 14 basis points. In our bull case, we're assuming 39 basis points So it does go a little bit of a wider range in for this one, but it's also a much smaller portion of their business. So I feel reasonably comfortable making that type of prediction. Then for the other section of the revenue, this one was a little bit tricky because I also couldn't find too many measures to necessarily scale it against in a particularly active way. But then we did end up finding the best way to go against it is against the total client assets. But it is a very, very small amount of income. So if you scale that against the client assets, it ends up looking like it's even less than 1 basis point or around 1 basis point in general on average over the course of the last decade. So in general, we basically kind of ran with that, and I did change it a little bit over the deviation of this, but likewise with the bank deposit fees, it makes up a pretty small portion of their business. So I don't think necessarily being super wrong in this category has the largest of impacts. For the most part, to be honest, it's the net interest income, the asset management and admin fees, and the trading revenue that really makes up the real bulk of the business in general. But either way, with scaling up, we get to a 700, almost 800 million in the bear case estimate and possibly up to 2.3 billion in the bull case estimate. So that's all the different categories of the revenue, which if we put them all together for our estimates, it gets us 14 billion in our bear case estimate and all the way up to 59 billion in the bull case estimate. Keeping in mind that they were at about 20, almost 21 billion in 2022. And also keeping in mind that, for example, if we scroll back, you can see this is up from 5.4 billion in 2013, and they had already doubled their revenue up to 10.7 billion in 2019. So you can see that they already did have a pretty significant amount of growth even before they had the integration of TD Ameritrade, which had obviously such a significant impact on the rest of their business. Yes, there has been even a pretty much larger increase in their business ever since then. They basically doubled from that 2019 period up to 2022. So quadrupling the revenue over the course of the last decade. So the idea that perhaps they would get close to tripling their revenue again over the next decade, while it might seem like that's a very, very high bullish estimate, I would actually say that it's not necessarily unreasonable when you think of it in those terms. Also, against the fact that their entire business model is based around taking a small cut of a very, very large pie, like these asset bases themselves. So the point is yes, the potentialities here are pretty extreme, but I tried, like I said, to scale that back in terms of our bear case estimate. And our bear case being 14 billion shows that that would be a pretty significant drop from where they currently were in 2022. That's like a 33% drop overall over the course of the whole decade. But either way, on a compounded basis, that would be negative 3.8% per year over the decade. And in the bull case, we have about 11% CAGR for the revenue. The point, the base estimate being 3.7 per year for the revenue. Coming down a little bit further to take a look at the operating expenses of the company does provide all their operating expenses broken down into several different categories of compensation, professional services, occupancy and equipment, advertising, communication, depreciation and amortization, as well as fees and other. We are building through as many of these as possible, trying to scale them against other things in the company as we were just talking about. Quite a lot of them are really just as percentages of the revenue, but a few of them go into some interesting, kind of unique directions. Taking a look at the compensation over the course of the last decade, it's on average been about 33.5% as a percentage of the total revenues. In the most recent year, being about 28.5%. We have in the bear case being a little bit higher than that average at about 36%. And then in the bull case, it comes down to about 31%. So really kind of hugging around that average. Though, like I said, it shows that it was less than 30% in the most recent year. So could argue that this is one area where I'm being a little bit more conservative. With that, we end up with about 5 billion in the bear case for that expense, 18 billion in the bull case. For professional services, we have that also scaled against the revenues. On average, we found it to be about 7%. In the most recent years, it also was a little bit lower than that average. This again might have somewhat to do with the integration, that those things might start to even out and come back more to normal levels over the course of time. In our bear case, we have it being above that average, about 7.5%. In the bull case, about 6.5%, which scales up to about 1 billion in the bear case and 3.8 billion in the bull case. Likewise, with occupancy and equipment, it's on average been about 5.4% as a percentage of the revenues. And we have that being about 5.7 in the bear case and about 5.1% in the bull case, really hugging around the average pretty equally. But that scales up to about 800 million in the bear case and a little under 3 billion in the bull case. Advertising as a percentage of revenues on average has been about 3.6%. In the most recent several years, it's been less than 3%, even going back before the acquisition itself, ending at 2% most recently. In fact, if you look pretty consistently at this measure, It's pretty much consistently been coming down over time, which might have something to do with the fact that advertising itself doesn't necessarily have to be scaled against the revenues of the company because it's something that you're in general trying to do on a more forward basis, trying to acquire new clients, right? But nonetheless, we still chose to hug it around the average there. So this is another category in which you could argue I'm being conservative for taking that approach. But we use 4.3% for the bear case estimate and 3% as our bull case estimate, getting us up to 600 million in the bear case and 1.7 billion in the bull case. Now, taking a look at the communication expense, this is one of the categories where I found a little bit more of a different approach rather than just taking it as a percentage of revenues. The one measure that gave me the lowest amount of differences over the course of the last decade, depending on how I want to look at it, was actually scaling it against the asset base. This might have something to do with the more assets you have, the more amount of communications are going to be necessary for the management of those things. It's hard to say exactly why that is the case, but I tried it against the revenues and I tried it against the assets. I tried it against the total client accounts, and in all of those measures, one with the smallest amount of deviation year from year was by scaling it against the asset base. But if we look back over the course of the decade, it's averaged about 1 basis point, pretty consistent around there. Obviously, if we went down below decimal points, we would probably find that there's a little bit more of obvious deviation there, but nonetheless, we still kept it very similarly with that. It shows 1 basis point across the board here, but there is still some deviation being put in there. Like I said, it's just so small that it's less than the 2 decimal points worth, getting us up to around 800 million in the bear case estimate and 1.3 billion in the bull case estimate. Now, for depreciation and amortization, we actually scaled this one against the interest bearing assets. Hard to say exactly why the interest bearing assets showed less deviation than the overall client base, but that was what I found to be the best measure against this. Depreciation and amortization, since it is in general a result of the type of assets that you have taken on, whether it's property, plant, and equipment, or possibly the amortization of acquisitions. That might have something to do with where they got the interest bearing assets relative to the rest of the client base. But either way, I found this to be the most consistent measure, being about 10 basis points up to maybe even 20 basis points in the most recent several years, on average, still being about 10 basis points. And we ended up scaling that for the bear case to about 15 basis points and then to around 12 basis points in the bull case estimate. Now, with this one, obviously, as I just said, there was around 20 basis points in the most recent few years. But as I was also just talking about, depreciation and amortization is a different type of charge that tends to go down over time unless you're doing more acquisitions and or you're making huge amounts of capital expense into property, plant, and equipment, which that's not the type of business that Schwab has in the first place. So without necessarily some huge announcements of a huge new acquisition or something like that, I would actually expect this measure to kind of come down over time. And it is a relatively small amount relative to all the other expenses at least put together. So if that's maybe a wrong assumption, I don't necessarily think it overly counteracts some of the other areas in which I was being more conservative. I think this is perhaps an appropriate way to approach depreciation and amortization in particular. Either way, that gets us up to about 740 million in the bear case estimate and around 1.6 billion in the bull case estimate. Now, fees and other, I found this one to be most easily scalable against the advisory assets, which is a little bit different than the other categories as well. Over the course of the decade, ebbing and flowing between about 2 and 3 basis points, on average around 3 basis points. You can see similarly for the 2032 estimate, we have it about 3 basis points in the bear case and about 2 basis points in the bull case, which gets us up to about 1.2 billion in the bear case and 2.1 billion in the bull case. So with all of those expenses put together, we can then subtract all those out against the revenue, taking also into account the interest expense as well appropriately. That gets us to an approximate earnings before taxes, not exactly operating income. It's actually more of an earnings before taxes measure of about 3.7 billion in the bear case estimate versus 27.3 billion in the bull case estimate. Keeping in mind, for example, that they have 9.3 to 9.4 billion of that same measure in 2022. As I was kind of saying against the revenues, you can see there's a huge amount of variability for the revenues between the bear and the bull case estimate. While you see pretty likewise, in fact, even more so for once it gets all the way down to the earnings before taxes, which should be expected. As I was just talking about earlier, being a company that takes a small cut of a very large pie, it kind of makes it a little bit tricky to make estimates of exactly where that's going to go over time. And so to kind of counteract the fact of the scaling up in the bull case estimates, I tried to be extra conservative in some categories, and that conservatism does have its cost, showing that there's potentially a huge decline in the earnings before taxes that they could be having relative to where they were in the most recent few years. Taking that as a percentage of the revenues, that is 26.4% in the bear case estimate and 46.1% in the bull case estimate, 37.7 in the base case estimate. I also did take the compounded change in the earnings before taxes just to get an idea of what's happening there. In this really bear case estimate, that gets them to almost negative 9% on a compounded basis over the course of the next 10 years. In the bull case estimate, that gets us up over 11% per year. So pretty substantial overall. In the base case, that ends up being a little bit less than 2%. So huge variability in this distribution of outcomes, but either way, I think it's kind of appropriate given the type of business that Schwab has, and you can kind of see that variability in the overall historic numbers that they've shown over the last decade. Now, scrolling back up to the top, there was one line up here near the top that I actually chose to skip and take a look at and kind of address after taking a peek through all of the numbers in this model, which is essentially a sanity check that I kind of put in here. In their 10Ks, going back at least to 2016, they didn't provide this numbers going back further than that, but in their 10Ks, relatively high up when they're describing their business, they talk about the US investable wealth, which they describe as essentially being a combination between the money market mutual funds, bank account deposits, investment assets in general across the US economy. And they say it grows from about 30 trillion, or actually they label it as more than for all of these figures. So more than 30 trillion in 2016 to more than 45 trillion in 2018 to more than 50 trillion in 2020, more than 70 trillion in 2021, and then down to more than 60 trillion in 2022. Obviously, we had a huge drop in equity values to make up for that. And so, what I chose to do was try to take a look at their slice of that pie, which was basically part of the reason that they mentioned it in the 10K was that they were showing this percentage, or they didn't really mention the percentage, they just showed the number relative to their client assets, basically saying, look, there's lots of headroom for us to acquire more client assets relative to the overall assets that are available within their market. And sure enough, they had now 9.3% as this percentage in 2016, and it's up to over 10% and a little bit less than 12% in 2022. And what I chose to do was try to think about this in terms of where these numbers could be going over the course of time. I went to the Federal Reserve website and I essentially tried to put together my own way of estimating kind of the similar measure that they had put together. It's not exactly the same categories that they mentioned. It's kind of mostly the same categories, but I was trying to find different measures on the Federal Reserve website that didn't overlap. But I'm including currencies, treasury securities, municipal securities, government-backed securities, federal, not federal, public equities, as well as insurance and pension numbers that aren't included therein. And what I chose to do was kind of take a look at this and compare it to the numbers that they were talking about in each of those years. And while it does deviate a little bit from them, it does at least keep the course generally, and it is pretty close in most of the years. So I found this to at least be a pretty good proxy for that. Then what I chose to do was to take this measure because I wanted to try to get an estimate of where it could be going forward in the future. I took this estimate out, and then I also chose to break it down into real values versus nominal. So we have the growth in different quartiles over the course of time ever since 1945. That if you were to just use any random quarter and to take a look at what the compounded basis was over the next 10 years at any of these points in time and take kind of the different percentiles of that, essentially over any random 10-year period since 1945, this US investable wealth has grown anywhere from 6.1% to 8.8% for the interquartile range. And then if you strip out inflation to get ourselves a real measure of the growth over that, that ends up being about 3% to 5.2%. And over that same period of time, we had inflation anywhere from 3 to 3.4 for the interquartile range for these averages over these different periods of time. And so what I chose to do then was to essentially take the real growth in investable wealth as a kind of a given. We'll sort of assume that perhaps we could achieve this similarly going forward. And then in my mind, the real question is perhaps what inflation might be, because it can definitely vary pretty significantly. So what I chose to think of for the forward potential inflation is that perhaps forward inflation could be a little bit higher than the highest point in the third quartile range of the past, possibly up to maybe like 0.5% more, so 3.9%. And then in the lower bound, I chose to be a little bit more on the conservative side, assuming that perhaps it might even be 1.5% less than that, so bringing it down to 1.5%. Now, if you're concerned about inflation, you might say, well, why are you doing it that way? Well, The thing is we're using this as a sanity check, not for our actual projections. And so actually having a smaller US investable base will make the percentage of clients for Schwab higher. And that means that it will have harder time passing muster for the sanity check. So it actually makes sense to be conservative to the downside for this particular measure. The median here, which I have obviously colored a little bit different here, is because I chose to actually take the projected 10-year forward inflation based off the TIPS rate as it currently is, which is about 2.33%. And so that's basically the measures for inflation I was going to use. And then I extrapolated upward to a nominal rate for investable wealth growth based off of, like I said, the real growth rates that we saw before, and then just added in my forward expectations for inflation that I use here, which gets us to anywhere from 4.6% per year over the next decade to 9.3% per year over the next decade, on average being about 6.6%, median 6.5%. So then if I take this 60 trillion that we have in 2022 and I chose to grow this measure by those growth rates that I came up with that kind of little basic economic research, I end up with possibly $94 trillion in investable wealth in the United States in our bear case assumption, and possibly up to 146 trillion in our bull case assumption. And if I take the total client assets that Schwab has as a percentage of that, we end up with 9.2% in our bear case estimate and 12.7% in our bull case estimate, which if we compare that against the measures that we saw in general over the several years we saw, well, the lowest point they had was 7.2%, but the highest point they had was 13.4%. So in either case, you could argue that those cases were on either side of these bear and bull case estimates. So I think that at least showing that they're kind of in the middle of what we've seen historically means that they're probably not, this isn't necessarily a reach to assume that they get these types of assets, assuming American wealth was to continue course on a similar basis. And of course, keep in mind, like I said, I was using nominal numbers there. So obviously a decent amount of this might come from inflation, but that doesn't necessarily matter to this, right? That's not really, doesn't really make a difference because we're not really talking about rates of return exactly. We're just talking about growth of wealth in general. So now coming over to put all these estimates into our DCF template and spit out a nice value for us, we have the revenue growth paths. In the short run, I'm generally relying on kind of what the analyst seems to be believing things are going to go. And then in the long run, we have things moving towards my estimates over the course of things. So about 17 to 18 billion in 2032 in the bear case, and possibly up to 57 billion in the bull case. Is a little bit different from the numbers there, but like I said, it just kind of gets us in the ballpark. I try to, in general, just have the average of the three be similar to the average of the three on the details page, not maybe a little bit more conservative. Coming down, you can see how those cumulative growth paths look right here versus the incremental growth per year. And then coming over to margins, I did similarly with the margin estimates, coming up to about 25% in the bear case estimate and up to 45% in the bull case estimate, 35% in the median there, allowing for pretty significant ebbing and flowing over the EBIT over the course of that. This, again, like I said, being an EBIT margin, not necessarily an EBIT margin, which is what we usually do. And you can see that in the short run, I'm actually assuming that the margins will increase, and that partially has to do with further integrations with their acquisition there, but then we can have them kind of move downward over time towards the more terminal levels, which, like I said, I think I was being reasonably conservative in some of those estimates. So I think this is pretty appropriate. And you can see the distribution for the EBIT income in the 10-year forward period right here. Then coming over to the discount page, we can see how the actual fair values come out. The implied terminal multiple that I use for the discount rates and the growth rates I have put into the valuation gets us this distribution here, hugging around kind of this 15 to 17 range for the vast majority of the cases, though some potentialities for lower multiples and higher multiples. I will say in general, this type of business does typically trade at a pretty good multiple in general compared to some other financials because of the stability of their business. And Schwab historically has in general received a pretty decent premium themselves, though for the most part, we chose to kind of strip out as much of that premium as we thought was appropriate. The interquartile range for the valuations we got was about $45 to $71 or so. A pretty decent spread right there, with the expected value being about $61. And if we come down to the distribution, you can see that the distribution itself actually skews pretty hard to the upside. Obviously, the upper quartile was still cut off at the 71%. So most of the bulk is really right around here. But there really is some potentialities for it to be skewed super, super hard. Obviously, coming from that really, really high potential revenue in some cases, and also some pretty high margins in some cases as well. So combine that with even a healthy multiple, and then you end up with some very, very high valuation. So of course, like I said, we should really probably pay most attention to the interquartile range if you want to think about where the majority of the outcomes actually are. Then coming over to the final page, you can see here is the valuation summary. As I said before, the margins should be thought of as EBIT margins, not operating margins. The tax rate is still relevant, but there's effectively no reinvestment as a result of that. And as you can see right here, fair value about $61 per share, with the percentile of the value distribution is currently trading at about 45 percentage. And then 10-year forward COGR, we see about 8.9%, a little bit of upside, not necessarily the greatest of expected returns, partially because of the distribution between the terminal multiples, but either way, some upside if you were a current holder of Schwab right now. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for Charles Schwab Corporation. As I said at the start, this has definitely been a highly requested company for some time, and it kind of been sitting on the back burner for a while. So I'm definitely happy to have finally got around to it. I'll catch you all in the next valuation. Bye.